Look at the stock market. Many indexes have risen after being sent down dramatically. Today, stocks seem to defy fundamentals, logic, and gravity. Nothing seems to bring them down. The worst economic indicators ever, in some cases, had no negative impact on stocks. Clearly, this is not a good sign. This is a contrived market, one which doesn't respond properly, doesn't behave normally. Surely, this will be an interesting ride. You came here for the truth, so let me unveil that for you. Today we're going to look at what's happening in the markets. We are going to see this and analyze it in depth. I'm going to show you what's going on behind the scenes. You're not going to get this on CNBC. You're not going to see it in the mainstream. The average financial advisor has no idea what's happening. In fact, the average financial advisor loses money for the clients, particularly because all they are is fee collecting units. That's basically what they do. They are human resources working for the financial institutions to bring money in. They take that from you as the customer, but that's a side note. So let's begin. Before I get into more detail about this issue today, I want you to keep this in the back of your mind. Equities rally despite outflows. This is brand new information and it's coming out of Citi, but also the EPFR. I have highlighted the EPFR on many videos in the past. I just brought this up, I think it was yesterday's video, but wanted to make this clear before I move into the other information. What we have right now are actual outflows in many cases. Money is moving out of the stock market, and that seems very illogical because we've seen the stock market moving higher. So how could this possibly be? Well, there are a few things that are connected in with that. I'll show you one specifically today. In fact, I'll show you both today. And I think it's important to remember that as we look at this information. Now, when you see this, it isn't just one-sided. We're not seeing money moving all the way out, and where is it going? Up in the sky? Is it sitting in cash? I have, really got into those details before. But I just wanted to make it clear that there isn't so much money moving in pushing these stocks up. There's something else going on. The next thing I have to show you is this. Out of Goldman Sachs, we're looking at the 5 largest stocks having returned 15% year to date versus minus 8% for the remaining 495 stocks. Isn't that a little bit absurd? Yes, there is a recovery if you see it from the bottom. But make it known here, we're talking about minus 8% for the year still. And yet, when you look at what's happening in the mainstream media, they say stocks are up. Stocks are up. Why? Number one, because they're looking at it from the absolute bottom. But of course, when you see it, including the FANG stocks, we all know what this is about. When you see that, they are pushing the markets up higher. They are up significantly from the bottom. There's no doubt about that. And we have to see what's been happening as all of this information has been really piling on, making it very confusing, making it very difficult to pay attention to. But I'll show you some details today, and I think it really highlights the point. This is one very important factor. S&P 500 sectors announced buybacks. You have seen many different sectors that have said we are stopping or slowing down our buybacks, as they would during any cycle like this. When things start to become a little bit more difficult, whether it's something that hits really hard, whether it's just a slowdown, you have the companies that will come out and say, okay, for the next little while, we're not going to do the buybacks, we're not going to do the dividends. Very typical. However, this time around, we have quite a few buybacks, but it's just this one. And of course, it shouldn't surprise anybody. Infotech. The infotech sector is the one that's going to be pushing stocks up higher, and they are the buyers. Yes, you have retail buyers, but they make up a small percentage when you compare it to all the others. The retail buyers, in many cases, you're getting a select group of them buying into certain things. But when you see it on the whole, a lot of them are actually cautious right now. They're in money market funds. We've seen massive flows into money market funds this year. But essentially, we got the FANG stocks that are doing their stock buybacks and they're pushing this market up higher. Will you get this information in the mainstream? Of course not. But I guess that's why you're here. This chart here shows you the recently announced buybacks, and you can go down the list and see it for yourself. You got consumer discretionary in here, information technology, and others. If you want to take a look, you can flip through this. I actually have a video that's available to you in my playlist that you can see for yourself, and I show you how to get the recently announced buybacks, a few different websites. There's stuff in there if you want to check it out, but just wanted to show you this list right now as it is updated. And essentially what we're looking at is money going into the stocks. They are the biggest buyers in many cases anyway, and that forces it up higher and higher and higher because they finance all this not with the cash pile that they may have. They finance it with debt. So they can just infinitely push their stocks higher, at least during certain situations. It helps out, it helps to boost them up. And as we can see though, throughout 2020, yes, these stocks can come down significantly in a short period of time despite all the buybacks that are happening. So it's this gravity and this deflation versus inflation that's taken place. I told you I would get you new information on the Bank of Japan and the amount of ETFs that they own. Well, Deutsche Bank provided this chart and it is unbelievable. The Bank of Japan owns almost 80% of all ETFs domiciled in Japan. This is unbelievable. Take a look at the ownership here of the Bank of Japan. We're talking about the central bank. They print money out of thin air and they buy the ETFs. That to me is crazy. Of course, they're also major buyers of the government debt and so much of the other garbage that they've got going on. This isn't a good thing. This isn't positive in any way, shape, or form because they're displacing all of the real investors. Think about this. As the years have gone on, and it hasn't been that long, if you see, they essentially had nothing after the financial crisis. And as time has gone on, as the real investors have been leaving the ship, they've been bailing it out. And this is what's also pushing markets up. Because you have the Federal Reserve, for instance. They're buying up the corporate debt now. They're buying up municipal. They're buying everything, essentially. They're buying ETFs. They're buying the broad market. And in this respect, it is important to understand what they are doing on a deeper level. They are creating price inflation, but it doesn't have a direct impact like you would think. If they're just going to buy these ETFs, well, then it's only going to make these things go up higher. No, it doesn't work like that. Understand it on a more broad scale. This comes from Real Investment Advice, a good website that's constantly giving out free information. Currently, investors have gotten back to more extreme stages of bullishness as the market has relentlessly rallied from the lows. And this is a good chart because it shows us the put-call ratio. And essentially what we're trying to determine here is how many people are pushing this higher, how many want it to go lower. You can see this. The pink lines right here is just showing you where I want you to focus for a moment. If you can see that, I know it's kind of small, but when we get into this really high level, this really marks a moment in time where stocks will fall. And you could see time and time again where this does happen. It's not perfect, of course, but it just tells us that we are getting a little too hot and heavy. And that had happened, of course, during this period earlier this year, and we are at that moment again. So this is just one indicator of so many that I've shown you, but it happens to be a fairly good one at that. Out of the Financial Times, Citigroup said financial markets were way ahead of reality with tougher times to come, warning corporate clients that they should raise as much money as they could before the true cost is factored in by investors. Think about that for a second now. The market has been overreacting to everything that's positive and simply ignoring all that which is negative, and that's not good. Quote, "We definitely feel that the markets are way ahead of reality. We are really telling every client to tap the market if they can because we think the pricing now couldn't get any better. As the second quarter comes along, we start seeing the pain and the collateral effects of that. We think this is going to be much tougher than it looks. That's really good information there. And I noticed he used collateral effects as a term. I like to use domino or ripple effect, but we're talking about the same thing here. Because you can't just think that this one thing that's going on right now, 2020 crisis, is not going to have an impact on these different sectors that might be affected. Okay, it's just travel industry that's a problem. This area of the country not affected at all. No, it doesn't work like that. There are certain patterns that occur, and you can see them if you pay attention. This article here is talking about Toronto, but it applies to many cities. Major Toronto businesses to keep staff home until September. The point I'm making here is that when you see the possibility of businesses closing for 6+ months, what do you think the impact is going to be? Look, you've got big businesses, the big banks, for instance, that can do so. They can have their employees working from home and get everything done. But all of these big businesses, they have small businesses surrounding them. Let's say they had the big towers downtown. Well, what about all the food courts and the little shops that don't have any customers anymore, or maybe they have just a few per day? They're going to be ruined. They're going to be ruined. They can't get a loan from the government and it's going to somehow fix the problem. People need to wake up to what's really going on, and this is more than what your portfolio looks like, I assure you. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you are supporting me, so I want to thank you for that. If you want to check me out on Instagram and Twitter, you can do so at The Money GPS. If you want to sell products online, you want to understand e-commerce and everything to do with this, then I've got a free e-course for you, the AmazonGPS.com. Learn the financial system, be empowered, get the knowledge, and you could do so in my 2 books. The link is in the description of this video if you want the audiobook, themoneygps.com. I made this video to describe what's happening right now. It is very relevant. It is very important. Click it. I'll see you there.